Yo, yo, yo. What's up, everybody? It's your boy Jamal back at it again with another video. Welcome to No Limit FX Academy. Okay. And I'm super, I would say, I would be lying if I didn't say I wasn't a bit excited to be touching on this particular aspect in the section. If you could tell already by the title, we'll be going over today about the Fibonacci. And the reason why I'm kind of excited to go over this a little bit is just primarily because Fibonacci is something that is hidden in plain sight that many people aren't in fact aware about. And I wouldn't say there's all too many reasons why people aren't, they're not knowledgeable about it. But all Fibonacci is just a sequence of numbers that kind of over time create this kind of spiral effect. Before I even go into the actual Fibonacci sequence, let me just go on Google real quick so I can show you something. Fibonacci sequence, math is fun. Fibonacci. Basically, Fibonacci is able to be seen in almost anything in all aspects of just life in general. And the cool thing about Fibonacci is these numbers kind of like let me try and show you real quick what I mean. So is it gonna show it? Dang, what is up with that? But Fibonacci numbers, so on and so forth. Basically, Fibonacci numbers go in a sequence, and it's kind of like 0, 1 plus it. All right, let me try and zoom in for you so you can kind of see it. So you kind of it's pretty straightforward and simple. I just want you to understand it. So when they have this sequence, right? Let's just say 0, 1, right? When you plus it, it equals 1. Basically, right here. So when you plus the number that comes third to the second number, 1 plus 1, you get 2. So when that sequence has started right here, right, you're kind of keeping along that type of concept, because now you'll do the 1 plus 2 is 3, right? So once you do that, you now have gone to 1 term, 2 term, 3 term, 4 term, 5 term. So you're on the 5th term, now 6th term. You could kind of, without looking at all of these things, you could kind of predict, if I was to like black it out, you could kind of predict what kind of would go right here. Like I can't really draw any box or anything like that. But if you were to not look at this, right, 2 plus 3 is 5. Boom. So you would know that this is the 1, 2, 3, 4, 5, 6 sequence. And if I had to tell you, what would you think the 7th sequence was, you would just do 3 plus 5 equals 8. Same thing for the 13. 5 plus 8 equals 13. 8 plus 13 equals 21. So on, so forth. As you can see, the cool thing about Fibonacci is when these numbers are set in these type of series, right, they kind of become, in a way, not predictable, but you can damn near estimate the next number of the sequence. You can get like a accurate bias, so to speak. So the thing with Fibonacci and how investors use it and stuff is they kind of calculate pinpoints as to where the golden ratios are for when the market actually hits a certain area in the market, because we're able to actually utilize it as some form of support or resistance. Like, look, makes a spiral. When we make squares with those widths, we get a nice spiral. And this is just overall showing the calculation of the numbers when you're I don't know how they're exactly doing it, but Fibonacci's within everything that we see in nature, whether it be a sunflower, you know, even a shell of a snail or like something like that. But it kind of is hidden in all aspects of life, is something that's all I wanted to show you. Because besides that, like even these type of flowers, these type of flowers that the aloe, they kind of give off the Fibonacci, and it just is a run-on type of story with Fibonacci. And I just wanted to show you guys that to kind of show you, like, watch Fibonacci sequence in nature. Watch. I just want to show you something that's really cool. Shells, as you may have guessed by the curve in the box examples above, shells follow the progressive proportional increase of Fibonacci sequence. Like, everything is within Fibonacci is kind of the tall tale of this lesson. Just so you understand, I'm not teaching you, showing you something that's impractical that you aren't going to be using on a day-to-day basis, or better yet, you're not even seeing, but it's in front of your face on a day-to-day basis. Everything kind of comes in a sequence of Fibonacci. You just have to be more aware about it to understand it in a way. But enough of that. Just going off. Yeah. So the thing about Fibonacci, well, let me show you guys this real quick before we even get into this. Do I want to do it on here, or you know what? I don't want to do it on any of these because I kind of marked them up in a particular format. Let me try and do it on this. Yeah. So just remove all drawings, right? Go to the highest time frame again. And overall, I just want you to kind of have this concept down. So when we kind of go into it, you're not lost. So I already showed you how the uptrend sequence happens. I already showed you that. Like, you already should know. And then go up here. We'll break down. It's cool things right here. All right. So look, basically, this is market structure, hypothetically speaking, right? Just for example purposes. I'm gonna show you something cool. So basically, when I was showing you the lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, highs, lower low, lower high, and so on and so forth, you kind of are able to use Fibonacci in a way to kind of I don't want to say estimate, but at the same time, the Fibonacci has PRZ zones, right? The PRZ zones are possible reversal zones, possible reversal areas. And I'm going to show you the ones I'm talking about right now. So basically, this is all of the Fibonacci sequence, I will say. And I'll change this color just so you guys can see everything. And I'll change these down here. So here is what I just want you to kind of sort of, I want you to remember it, but it's not, you know, to be like, you're going to extend further on it. You're going to learn more about it through experience. But I'll just say it like this. There are a number of possible reversal zones, and the possible reversal zones start with the 38.2, right? And this number is kind of sort of like this. When we're seeing the market go up, right? And it goes up to the 0%, right? From the 100% mark, because we're always drawing our Fibonacci's depending on the trend we're in. And I want you to kind of remember this as like the foundation of things. When you're in an uptrend, you're always going to draw your fibs from the low point to the high point. Always an uptrend, always from a low or a higher low to a higher high. You will always do that in the uptrend. In a downtrend, you always do it from the lower high or the highest point to the lower low, lowest of the points. And that's always going to be in a downtrend, not an uptrend, and the same for the uptrends. So when you're seeing this market structure, you're going to always do it like this. You're always going to make sure that the point you're drawing it on is the lowest of the points. It's literally the low. And I'm just going to type it out so you guys can see it. But literally just like that. Nothing more, nothing less, to the highest point, higher high. Right? To estimate the counter trend to kind of measure the counter trend to then it creating that higher low. The thing about Fibonacci is it kind of, since it does measure the counter trend, like when the actual trend is going against your, let's just say if my bias was downtrend, right? Let's say like this, structure obviously broke down here. Obviously did, like right around here. Just for example purposes, it broke down, right? I wanted to see in a way how I could kind of gain an entry, insight. So not don't do it like this, but this is just an example. I would therefore extend my fib out to where I found support at, even though this I wouldn't necessarily do it on here, considering that long ass wick. But I just want to show you guys an example in the actual market structure. So basically, I will measure how far the market could possibly come back up to come into one of these PRZ zones. As you can see, it landed right there on the PRZ zone. And not only that, I'm able to find my actual resistance, as a sort of mean that the market hadn't been able to kind of breach or go over. And I've kind of gotten this area or section where I'm able to actually apply certain things, understanding and knowing where I'm at in the market. And as well as that, look at how it came back up, right? And tested where it actually previously had broken. And that is something that is very common in the financial world, where you'll see just in technical analysis where a market structure will be broken and it'll eventually come back and test a certain area that it had broken. And you can see that on a line chart as well. It never really passed that area. At the same time, it never really, it just showed confluence all in that area. So that's kind of what you'll be measuring in counter trends when you're using a Fibonacci, because that ultimately is how Fibonacci is used, because throughout these certain actual PRZ zones, they measure the extent of which market can go in a way, kind of like, so I'll do it like this. Here we go. Basically, it's like this. When the market is counter trending, right, it can do several things. And I'll try and do it up here because we're getting a bit messy right there. So where is it? So when we go up, right, and pull back, this is basically what I can see from the market. If it comes to 23.6, right, it's seen as this is what 22.6 entails. It's a continuation / pause before a trend continues, meaning that when we see this happening, right, sometimes market structure won't exactly continue going down to these PRZ zones. So it will kind of stay within this area and kind of mess around a bit, right, to then actually shooting up. And that is known as a continuation. It's the 23.6 just area is known as a continuation and is not a PRZ zone. This is not a PRZ zone. And the reason for that is because all this kind of shows in the market is that the market had in fact paused for a bit, right? But at the same time, it didn't have enough sellers for this instance, since we're kind of representing an uptrend. It didn't have enough momentum. It didn't have enough buildup of just sellers to be able to actually push it to a verified PRZ zone. So this level right here, I just want you to always see this as a continuation. And sometimes I don't even have it on because this isn't what validates a higher, lower, high, or a lower high. When I've been showing you guys every time market structure in a diagram or just candlesticks in general, where higher lows are formed and lower highs are formed. And I never exactly came around to telling you how you'll know when a lower high is formed or a higher low is formed, but I'm going to show you in this video because that is one of the most important things that you must remember and that you must actually understand and know, because if you don't, it's not going to help you any better in the market alone, and you trying to decipher where you're at. It's not going to help you. So thing about this Fibonacci and how it can help you is, let's just say you're analyzing market structure and it does approach to 23.6 and it just doesn't continue going down. You shouldn't, I would say, see that as a valid higher low in this particular area. The only way you can estimate or see something as a valid point of a higher low is it has to at least retrace to the 38.2 mark. Once you see market structure actually hit this point, this is a PRZ zone. PRZ level. This indicates that basically market structure, or just market in general, was able to gain enough sellers to be able to push this market back within this facility to kind of make some sort of structure, to then be able to kind of break previous structure, to then be able to build up over time to kind of create that trend that we were kind of presumptively like our bias was continuing, or whatnot. But you overall have to still understand market structure along with utilizing the Fibonacci, because there's no use to the Fibonacci if you're not even understanding where you are in the market, or better yet, understanding market structure. So Fibonacci is just sort of a tool that could kind of align you with you understanding the trend that you're in, and based off that, understanding your highs and your lows, or your lows and your highs, you're being able to measure that counter trend and seeing how far it could possibly go before it actually is dictated as the trend reversing, going the opposite way, or that you'll be most likely probably encountering a steep trend rather than a short counter trend, a steep counter trend rather than a short counter trend. So the 38.2 is a PRZ level. The 50% is not, hint to why I have it red. 50% provides an imbalance. Right. So that's all the 50% does. It provides an imbalance between buyers and sellers. And not only that, it's just not seen as a PRZ zone for the implications of like I told you, the sequences and how they kind of start and spiral out in nature. The same thing for financial markets, or just TA, just charts in general. This level provides a clear explanation that within the 50% mark, the market had in fact retraced to the 50% mark, half of its move, right? They're just exemplifying, just showing that it basically came back half of full what it did. And I don't want to confuse you with that. It basically did this to then come back down and come back to half of what it had did. So it provides a kind of like still standpoint in a like literally in the middle of buyers and sellers, a good imbalance point within the market. You shouldn't see that as anything further. You just kind of have to see that as an actual area to where like, oh, that the market was able to come back within this area. And sometimes you kind of do want steeper counter trends because they provide a better R to R for you to kind of like make more than lose more. You're basically be able to lose less while gaining more. And I'll show you a clear example of that, because these levels up here that are green are known as your TPs. No. Okay. Known as your TPs. These are where you would traditionally take profit. Now, I'm not saying you have to, but this is your basically overall goal. Once the market reaches this level, you kind of want to dictate whether or not the trend will continue going, or you should probably take profits considering you understanding your candlestick analysis, and you're seeing markets come up here and they're overall making these long ass exhaustion points, kind of showing, oh, I don't think I want to be in that, still, so to speak. So you like candles like this that hit here, you'll be thinking twice on whether you should keep a trade in or not. And I've already explained to you and how this kind of should be seen in your eyes, But besides that, I will say the 618 is known as the golden ratio because this is what a market tends to drop down to the most. And this is just kind of where when the market hits this certain area, doesn't matter the trend that you're in, it has not a success rate or anything like that. I don't want you to see it like that, but more so just a overall statistically a better chance at outperforming and continuing its trend that it had previously been on. And not only that, these actual Fibonacci's have a sequence that they actually go into. So basically, once we're at the 618, and let's just say market hesitates at this area and increase like that type of a movement right there, this will be known as a higher low, obviously. So once the market starts trending in this fashion, right, it'll create moves like this. Probably, like I told you, it can consolidate to then continue its trend that it was in right there. So at the same time as you seeing these things happen, you're also simultaneously understanding where you are in the market with Fibonacci, market structure, understanding market structure, your highs and highs, your lows, your lower lows, your higher lows, and your lower highs, and kind of building up this intuition to kind of understand where the market could actually go given certain information and pinpoints that you're following. But the golden ratio is the 618 PRZ zone. That's known as a PRZ. $786 is a PRZ zone. And 886 is a PRZ zone. These are both the levels in which the market, and the 100% isn't really a PRZ zone, but oftentimes you can kind of see the market actually extend to this area, right? Oh, no. Right, you can see the market extend to this area, right? And kind of, in fact, still be able to be seen as trend hadn't been broken, right? Because remember, this is our low point, this is our high point. So overall, the market can come all the way down to 100% and still be, in fact, a bull uptrend, right? It hadn't necessarily broke this level down here until it breaks it. Hint to hint, why I have these reds here. These levels are known as our stop losses. This is where we control, where we put our stops to basically how much we're willing to lose. Yeah. So these are both our stop losses, stop loss 1 and stop loss 2, given the circumstance, depends on which stop loss you would in fact use, because in certain moments, let's just say this 100 or this 110% stop loss kind of maybe too much interfering with market structure or too close to the lows or in fact 100% mark. So you wouldn't exactly put it there. So my actual Fibonacci inputs are these right here, and you can kind of just replicate it. But overall the 1.1 is 110% on the fib, and this is the 120%. And so basically, given any trend that you're in, when you're actually anticipating certain trades, and let's just say you got in at any of these PRZ zones, right? Let's just say you got in at the 786, you would kind of put your stops right here, right? To then only be willing to risk, that much, right here, for all of this to gain. You feel me? And that's how you come up with that 1-to-3 risk reward ratio, which is a cool thing for you to actually be able to see right here, because then you're starting to see, wow, how everything's coming together. And this is the reason why I showed you guys in just the other free course and whatnot, because I told you later on, this all makes sense when you put it in harmony and together in a sequence with everything together. It's kind of like how I told you cooking is kind of made, and I'm not really that good of a cook. It's just me understanding when you put all the ingredients together, it could possibly make something delicious. And this is what I'm telling you, just within terms of finance. When you bring all of this stuff together, it makes for something delicious in terms of preparation, meeting just opportunity. And this is all that it is, guys. When you're able to utilize fibs in a certain way and get better at it and understand market structure, you can see how you could risk this much while potentially trying to gain this much, understanding that you're only risking 1% of your account while gaining 3 times what you're risking. That's all that is. And then look, if we kind of dropped it down to the 886 mark, therefore your numbers would change dramatically. Not anything crazy, but you would go from 1-to-3 to 1-to-5. And again, you basically can lose this trade up to like 4 times, right? In your 5th trade, you could potentially just win it, canceling all your losses while taking out profit as well, while making profit as well, because you lost the trade 4 times and you took it the 5th time and it was still a 1-to-5. So you would cover your 4 losses along with gaining that extra that profit that you were still keeping in mind when you were trading. So that's a cool thing that you guys are actually visually seeing. Even on 100%, now you're starting to see, wow, how you can kind of maximize and manipulate and utilize the stop losses as well as the Fibonacci to kind of create this dynamic where you're only still risking 1% while trying to 12x, your account, your gains or whatever and whatnot, because the market has in fact done this before, where I've been put in a position to where I've been able to utilize these levels and be able to truly make these type of moves happen. Like, it just all goes to show that it can all happen within time of you just understanding and preparing yourself. Now, another thing I did want to be able to show you while you are seeing this, these are actually good areas to actually enter, as you can see, because it provides a low risk, high gain reward. Now, once we get to like the 618 mark, things start to become a bit different. As you can see, the actual loss increases and gain minimizes. This is still very much the same as us entering in this area in terms of just like it being a good entry point, right? It just always matters with market structure, what is being shown, because at the same time, you have to remember your take profit 1 is here, and oftentimes your take profit 2, more than often gets hit as well. So this is still a 1-to-2, but at the same time, understanding and seeing where your targets are, you could kind of minimize the errors because you can only take certain risk to reward ratios to increase your gains, your profit, your wins, and decrease your losses and money you're losing. If we go up here to the 38.2, you wouldn't necessarily want to get in anywhere right here, because you obviously can see how much you're losing and how much you have at risk rather than have at gain. And at certain times, I'm gonna be honest with you, This is impractical the way that I'm actually using the Fib, because I'm not using it on actual market structure, but I'm showing you in a diagram format before we even go on the market structure, to kind of just be able to kind of have this in your head when we're going through it, because it makes it that much easier for you to catch on. This, I get on a lot of 38.2s, so this isn't in fact true where your loss is this much and your gain is that much. Like, this wouldn't even, practical setting, I would never take this, because of look how much I'm willing to lose. It just isn't called for. So you obviously can see the higher you go after the 50% mark, how much you're taking on in risk versus taking risk on down here below your 50%. You should kind of see these as discounts, right? Discount points rather than premiums. And at times, these premiums aren't as much loss. It isn't as much as you're losing as you would think. It's just in terms of me using this trend and seeing how wide I drew this actual just arrow. But that is something I want you to keep in mind when we're going throughout the market. So I'm showing you guys something, because at the end of the day, you want to be able to understand your R to R to where you're not risking your whole account. But that is in fact the Fibonacci and how we can kind of utilize it in terms of actual market structure. And so again, the principle or the concept I want you to follow is always in a uptrend, draw from the low point to the high point, right? And let's just say our targets do get hit. I need you to see this in your head as this is a new higher high once our target has been hit. So therefore, you able to modify your fibs again. You would be able to, once I showed you the valid higher low point, what creates a valid higher low point, anything past 30.2 is considered a valid higher low point or a lower high point, considering the trend you're in. 28.6s do not count because they show that the market had not made enough momentum to continue pushing its market down to create structure in order for you to find that actual established market structure to be able to utilize and find a possible entry point. And sometimes you can find a entry point on a 28.6. It's just you have to understand this is just like a standstill in a point in the market where it reached, slowed down, stopped, whatever, paused, and at the same time had in fact continued the trend that it's been on, considering just the momentum not being there to push it back down. So let's just say that happened, right? Higher low kind of got established, boom, boom, low to high, right? On top of this, did it go past the 28.6 mark? It did. So this is a valid higher lower point. It doesn't matter where it goes. It matters how you're able to embed this. And at the same time, I told you, oftentimes or not, it has to come all the way down here for market structure to even be seen in your eyes as broken. Meaning it has to break this, right? Break this point, right? And on top of that, it has to print 2 candles, like I told you in the previous lesson, for market structure to be actually, in fact, seen as broken in my eyes. It has to print 2 candles. It cannot print 1. It cannot print none. It has to print 2 in the same direction. If it doesn't, then I don't really care. It could do that and do this, right? And this would throw many people off. It would literally do this and they'll be like, oh my God, like, see these as candles, just a whole bunch of candles being made. Literally, if this happened and it went lower than market structure, right? I still wouldn't see this as a form of market structure had broken. I just wouldn't, because at the end of the day, you got to understand that we need 2, not 1, 2. So this wouldn't be valid enough for me. This is like, it could very well do this, like how I've showed you many of times in the previous lesson. And then look, you got yourself in a jiffy. And at the same time, this is why you observe and you see which stop loss to use, because both of these end up getting hit in this actual example I'm showing you. That market does very well often, a lot of the times. So you must be patient and you must wait, because in fact, you would be able to set yourself in a position to where you could in fact enter down here, right? While putting it way below your actual stop losses, while maximizing even more gains. And all you're doing is targeting the highs potentially trying to reach your targets to create a higher high to continue its ongoing trend by default. So you have to be able to see that and see the expectations of your trades pan out, because when you do that, by default, you'll be able and you'll be in the most conducive state to actually trade rather than, not really understand anything. Oh, shit. So let's just say it did that, right? At the same time, always look to past market structure because it could leave clues and it can leave confluences. Confluences are just your analysis that you've done and built up evidence to create a certain bias for yourself. Create like, oh, I see it continuing its uptrend, or I see it continuing its downtrend, considering the factors, right? The factors. And not only that, you also want to keep in mind your moving averages, because your moving averages that I showed you guys could very well be blue over red or red over blue. And let's just say on this side, they're blue over red or red over blue, basically indicating more bearish momentum in down push rather than uptrend. And the same for this. It's all added up confluences in. You very well can use the fib, the PRZ zones as confluences as well if structure is finding support or resistance on any given area. Now, oftentimes than not, you'll actually see the market come to this 50% mark and kind of not land on a PRZ zone. You shouldn't be scared of that. If anything, you should kind of understand it in a way to kind of formulate this is an imbalance point, but at the same time, I'm understanding that it's a battle between buyers and sellers, and I'm waiting to see which one outbids the other. You have to understand that psychological principle, because once you understand that, you break it down to lower time frames and then just watch and you just analyze and see where the momentum is shifting, because by default, what happens on high time frames has to happen on low time frames first. So if you're given this big picture that higher highs and higher lows are made, what has to happen in order for that uptrend to be even continued, for this push to even happen? On a lower time frame structure has to eventually be broken to create these engulfings. So when we're seeing this bullish engulfing on a lower time frame, like 30, 15, 5, lower highs have already been broken. So you'll be able to go down time frame, not downtrend, and find an actual entry point, because at the end of the day, this move right here is made up of these on lower time frames, like this. This is all that is happening on lower time frames, literally. And where's the last lower high of the lower time frames? Like kind of right here, right? So what happens when that happens and engulfing is made? What do you think that is? What do you think that's seen as when we're doing this on a low time frame? The same thing that we're doing on a higher time frame, you're doing a low. That structure has been broken. Possible retest. Let's see how it holds. Does it hold or respect it, or does it break it? It holds because we get some sort of engulfing. You take that engulfing variation, and on top of that, you ride the actual trend to your desired targets to then be able to understand that that is how it's done, and that is how you manage a trade. You hold a trade all the meanwhile understanding where you are in the market, because I've already shown you it's easy to lose where you are in the market by going down on an actual lower time frame when you're seeing a whole lot of more data, a whole lot of more information. So let's do this: higher high, higher low, higher low, higher low. This is what has helped me make money over and over again. And it just, let me see. Where am I? People don't understand why I see certain areas as a certain way, why I got out in a certain area at a certain time, why I got in a certain area at a certain time. It just all depends. And I'll even do something very interesting. So let me show you this. This happened, right? valid higher low past 38.2. Right here. Valid higher low past 38.2. I would even, in fact, let's just, for instance, it's like this. It's still valid. Very much still valid. Boom. Boom. Right? This happens, right? Valid. Because it had to stay up here for it to be kind of considered invalid. So once we got this push up, right, we didn't in fact hit our TPs. We didn't. But when market structure came back, look what it did. It ended up breaking structure right here. So I want you to keep this in mind as well. When this happens, you understand that this actual trend you're in is very steep. It's very steep. All meanwhile, structure had kind of just been broken with 2 candles. What you must understand is this. Although this higher low had not, like, is all the way down here and had not been breached until over here, and this higher low kind of became valid, it is upon you to sort of understand that this area is actually seen as valid, to be considered a higher low, right? So when you take that into account, it's not as if it's a 23.6. It's actually it was able to counter trend to a PRZ level, so to speak. So by default, you wouldn't necessarily just be analyzing, waiting for this to happen, because that's a lot of, I would say, unnecessary time to be wasting just waiting. Because at the same time as this, how I told you the market could always counter trend to 786, 886, even 100%. When you are still implementing that and understanding where you are, and you're like, no, it can still go up, understand that there's an actual other trend that's being created. So by the time this is broken, you wouldn't even take a trade here upon its break. You would be able to see a possible entry when it counter trends to a PRZ level, because then you would have to see that actual momentum be built up to then be able to push it to the actual TPs on the downside, So I wouldn't necessarily, you could keep these lows in mind, right? But understand that whatever is holding up is majority what's going to be continued. So let's just say it got to this area and it was so respecting, you were seeing wicks, exhaustion, as well as candles not being able to break past this point, then you would by default pull out your fibs, high to low, and see that it actually did meet a actual valid higher low PRZ zone. So then you would actually take advantage of this and literally trade it to the TPs. And a fun fact about the TPs that you probably didn't know, it always kind of aligns with previous structure, as you can see right here. And that is an actual indication to where you could have gotten out at, anticipating whether the market would continue going back up or whether it would continue going down. And based off right here, you could probably see that it kind of broke down a little bit. So again, since it did hit your TP and it did classify a lower low, you would be able to modify your fibs again, right? Same thing right here. It literally came up to the 50% mark. If it showed true rejection or breakthrough or not, you would then apply the same type of methodology and seeing how it kind of showed that imbalance, but it was still able to hold. You literally trade it down. Look, it creates a lower low all the way down here past your TP1, damn near by your TP2, and it could have even wicked there. And all the meanwhile, you're getting profits while maximizing your losses. So let's just modify our fibs once again. Same thing. It does not matter where it goes. It can go all the way up here. It still is valid as a lower high all the way until it breaks the previous valid lower high. You see? And the only other thing I will say is this. If you see market structure do something like this, right? Right? It's not the same color. Right? So if market structure does this and overall did hit your TP and you're like this now, right? You could not validate that as a valid lower high. It just, there was no momentum there. It just paused. Yeah, it came up and back, right? But at the end of the day, if we go on a high enough time frame, you wouldn't be able to see as much movement as you think on one time frame that you're analyzing on. So when it came down here to hit this TP, what you have to do is literally modify your fib again, right? To wherever you found support or resistance by the opposite candles being created by each other and showing some exhaustion to the downside or upside. And you literally modify your fib to then right there, right? To then being able to possibly see something like this happen. And guess what? It will have been tested previous structure that had been seen as a not valid, lower high point. And on top of that, it's also acting as resistance. It's also acting as confluence. Is like one confluence could be it broke, right? Two confluence could be that this 20.6 is being seen as resistance. Three confluence, if I'm in the right order, you could be seeing your moving averages red over blue, and break it down to lower time frames and you're seeing candlesticks and all that. That could be 5-6 confluences all at the same time. While again, you will be maximizing your gains, minimizing your losses. You wouldn't necessarily put your stop loss up here if you're analyzing on a high time frame. Hence to why I told you these are impractical examples, because sometimes when you're monitoring on a lower time frame, your actual stop losses, when you utilize them on a lower time frame, might be like around here or something. So you will literally be limiting your losses while maximizing your gains over and over again. Because on a lower time frame, there'll be structure in here to where you would kind of implement this and you would even bring it down a bit more. Literally minimizing your losses, maximizing your gains, understanding and knowing where you are. So that was just a clear-cut example of how to actually use Fibonacci in a way. And I'll give you some examples in the market structure so you guys can actually have that actual real evidence. Let me just kind of break it down a bit more to kind of give you that realness, that raw. Should I go down one more time frame? So watch this. I'll start right here and just go back, move back, right? So look at these moves that kind of happen, right? Let me kind of go back a bit more because trying to give you guys easy little ones. Market structure broke here, tested there, broke through, right? Therefore, this is the first of its move. Over time, it'll become easier to the eyes. Don't be so confused at how I got here, just understand that within time, you'll understand why I put it here if you don't already. Highs, right? Highs. It didn't go any higher. That's highs. This is a high. You can consider this as a lower high. The reason why, it's a little bit lower than that high, but at the same time, it's still all cuttable high. You literally can draw out this line right here, up here, to kind of see it like that, right? Now, market structure breaks down, breaks previous structure. Look at this, lower low. What is this? That retest I was telling you about. What happens next? After this happens, to then this happening. Overall, I told you these are your TPs. And at the same time, I even told you that you don't have to use them if you're understanding that trend is going to continue going down. It's just when you're seeing these wicks on these actual doji candles, you're not going to really, take that as something, but you're going to be aware of it until you're actually seeing these volumes be printed and you're like, oh no, there's still volume there, and hold your trades out. But let me just show you. Let me try and break it down one more time frame. Get a bit more actual information. As you can see, highs, right? Look at this, lower low, lower high, right? And look at the area it kind of found its resistance in 618 region. although it may look like it blew past it, you got to understand market structure is going to look messy on lower time frames as you draw it on the higher time frames. And at the same time, again, these areas are still able to be seen. Oh, shit. Look at that. One confluence, two confluence. Support turn to resistance is the second. This is the first. Golden ratio, 2. See? Watch this. The engulfing is 3. Let me turn it blue. Right? Us knowing it's turned over from like that uptrend to a downtrend is 4. You know, it's the fourth confluence. And let's just see if this is the fifth. Look at the fifth. The fifth, look at the EMAs, the SMA and the EMAs, red over blue, more sellers over buyers. There's 6 confluences all in one together, guys. That's kind of how you ought to analyze a certain area. You feel me? Because now look, now that we've seen that that's actual PRZ zone and it hit our TPs, what do? We modify our fibs. Look at this. So here's the truth of this. Here's the truth of this. We wouldn't do it on that doji because that's not where we found support. Where do we find support? On this bearish candle and this bullish candle type doji. But at the same time, it's red and blue. I mean, red and green. There's no green over here. It's just doji. So we would kind of ignore it, you know? Understand that it's there, but ignore it. Look what happened when I drew it right here. 23.6, right? Is that valid as a lower high? No, it's not. So what do we have to do? We have to wait for market structure to create some actual structure to then be able to modify our fibs. So we couldn't create any type of modification to our fibs until it got down here and we see this red and green. Boom. What did I use as our previous example just now? Just now. Literally just now. When I showed you that 23.6 mark starts to become acting as some form of resistance, which it did, also can draw out this actual exhaustion zone. Like, guys, I'm telling you, I don't make this stuff up. I literally don't. My eyes are trained for it in a way. So, and then look at the same area that it came back to. Look at that area. Look at the 618 golden ratio area that it literally held as resistance to then hitting our TPs, both of them. You see that? Not only that, we're actually seeing these actual kind of tweezer tops, but also to you, I can, just based off what I showed you, I know it looks like actual engulfing because look at what's bigger, majority. If that isn't the one that would have got you, this one would have made you for sure see that there was more sellers than buyers. I don't know why I'm using all these random colors, but look at this one too. Like literally back and forth, 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 back to back to back. And just like how I told you, you wouldn't necessarily enter on this time frame. It's too high. Right? Because then look how you're risking way too much to potentially gain. You're gaining far less than what you're risking. You're gaining far less than what you're risking. You're risking way more. Don't be that second person in my risk management 101 lesson. Be that person where you're understanding this, doing that, right? Breaking it down. Let's even go to the 30-minute. I'm just pulling these out the market, picking them apart. Look at this. This is like the median of where structure had been held on the actual 30-minute, broke through, right? Once it broke through, and we understood that this was this retest. The reason why it broke through and it came back, sort of like this, right? We understand that. Draw that area, that zone out. Over time, it get better, it get easier. So let's just say you missed this, right? You didn't get into it. You know, you didn't understand it at the time. Okay, that's cool. Where is it? Once you understood market structure, like let's just do this. Ooh, I see it. I see it. I see it. I see it. So, all right, I'm gonna do this. I'm gonna show you it like this. Let me take this off and keep this on and kind of break it down a bit and show it to you like this. So overall, you see this move right here that was on the 30-minute, you can see on the hour, right? Boom. Look, retested it, boom, shot down. I see that as a 23.6 because that move is so short that you actually can't measure it in terms of this actual counter trend right here. This one right here, look at it. You actually can see the market be able to pull it back up versus this be stagnant and consolidative, like literally in an actual box reference. I can draw a box around that. That's how you can start to understand and see, oh, no, that's a 20.6. I wouldn't majority take that. I wouldn't majority, kind of see that as a valid lower high. Like how I told you, this is a valid lower high rather than that one. Because look in terms how it just came back, right? So this would be your entry. You see how all of this jumbo stuff right here, you would literally break it down to a lower time frame, 30-minute. You would go time frame by time frame. And seeing as how we already understand where we are on a higher time frame, right? Because of just the golden ratio and that yellow actual box that I drew out as exhaustion a zone and all that. You basically would go on these 30 minutes, 15-minute time frames, and you see a shift in actual momentum to actually capitalize off the lower lows and lower highs being made on here. So your first actual entry, understanding where you were, honestly, watch this. It could have been like right here. That's the actual engulfing. Minimizing your stop loss to only 21 pips. That's actually like fantabulous, while trying to maximize your gains to the actual overall projection you have on a higher time frame. That's 102 pips. 102 pips, guys. You can't get any better than that. You really can't. So let me show you something. Watch this. This is one trade right here. And we got in off that engulfing. Off that engulfing right there. I'm giving it emphasis so you guys could kind of understand that, look, overall, regardless of it was coming back up, we understand that this area had not been broken because our 100% mark is still intact. It has not been broken. So look at this engulfing been made. And if you want to get any extra technical, we can go drop down to the 5-minute. We won't be able to actually go that far back. That sucks ass. So you would have been, in fact, able to actually use the 30-minute as well to see volume, overall volume. Because you even could have gotten off this engulfing right here, how I told you the variations. Take in mind, these are just dojis. You wouldn't even, you would ignore those. How I told you would overall sometimes have to go above or diminish certain things because it's just doji. It's just information you're able to actually understand. Look at this. This previous candle was bullish and this was bearish. You'd have been able to enter right there. That would provide another additional analysis on a higher time frame, such as the 30-minute, that kind of would have gave you that emphasis where momentum was going anyway, because overall we got this bullish candle, right? Which could have scared you in a way, thinking that it would continue going up. But overall, you still understanding your 100% mark is still intact. This trend is still intact after market structure have been broke over here. So then look at what happens next. We actually get that bullish engulfing to break it down, to obviously testing these lows out, right? We didn't get two, remember? So that wouldn't be considered as a break in my eyes. Not even that. All the way until we go back here to then breaking it down even more. That's when we start actually seeing it actually roll out. Overall, TPs were hit. almost there, but end up hitting it right there. And let's just see how long you would have had to actually hold this trade for it to pan out. You would have damn near had to hold this trade for like 5 days. But at the end of the day, 5 days, which is like almost a whole week for 102 pips, considering your account size, it like trust me, the skill there is there, and if you apply right, you'll be fairly compensated for what you know. You know, just to keep things in mind, I want you to understand something because that was a good ass example I just did, and I didn't even expect to do that. That's fine. Let's do this. So I just want to do this real quick so you guys can visually see what you could have made, because I feel like that's always important for you to be able to see, what's possible. You know, I need you to always be able to see what's possible. Whoa, tired of that shit. Boom. Right? Watch this. Keep that in mind. Keep that up. Because every time I traded, when I did this, it would literally blow my mind. Like opportunities I missed that I went back and back tested to see where I could have potentially got in at, to obviously make me more knowledgeable, intellectual about, okay, when this happens in the future, I'm going to be prepared and knowing this. So given that we know this 102 pips, risk to reward 1 to 4, meaning you can take this trade 3 times out of this whole period of just understanding market structure and being able to recover 3 losses off just one trade, the 4th trade, only risking 21 pips. So watch this. I want you to understand the actual just practicalness of this. You starting out could realistically start trading a 0.10. That's just $1 per pip. So watch this. $1 per pip. Watch this. If you're throwing a trade in for a 10-cent looking lot, right? 10-cent looking lot, you would basically do this and times it by 21. All right. You would basically be risking, well, it doesn't do it, but you're basically risking for each dollar, you'll be risking in total of $21. $21 and like 20 cents for this trade. But what are you willing to gain? 102 times that by $1. $102 while only risking 21. So you're risking $21 to therefore make $102. Sounds just about right. Okay, what about you getting more advanced? Standard lot, which is $10, right? Per pip. You basically be risking $10 times it by 21. So you'd be risking $210. Same trade, same everything, different person, different account, different knowledge, different retention, different discipline. Risking $210, right? And then therefore make how much? 10, what's this? 10 times 102. You're basically risking 210 to make practically $1,020. That's practical. That's not fake. That's real. Okay. Now let me show you something even more crazy. Something my mentors have continuously been doing throughout the past 2-3 years. $50 per pip times that by 20. 1. You're risking 1,000, right? They're risking 1,000 to be able to therefore make what? Risking 1,000. $1,050. You're basically risking 50 times 2. So you're risking 1,000 to make 5,000. 5,100. This is actually one of my mentors right now. He's actually going like nuts. He's risking when he throws a 10 lot, right? That looks like a $10, but it's really 10 lots, and that's $100 per pip. So he's basically risking 2,100 on this same trade that you're only risking $21 on, trying to gain 102, right? Watch this. 100 times 102 to try and make 10 bands, which is fairly easy given this market and understanding its actual, like, in all fairness. I just showed you 4 examples. One is you, one is somebody higher than you, one is somebody higher than them, and one is somebody higher than everybody else. So at the end of the day, that doesn't matter. The numbers don't matter. Ultimately, what matters is what you know. That's why I'm telling you, you want to understand this information to a T to, so to speak, get better at it over time to then honestly kill the game, bro, to be able to kill it. Because like I told you, you wouldn't put your stop losses all the way up here. That's nonsense. Look how much you're actually risking when you understand what you're doing. You're not risking that much. You're risking this much, potentially gaining that much. People don't see that. They fail to understand. Fail. You're not failing because you're applying it. You're applying actual information. So, I forgot that quote, but it's like somebody with knowledge, will always supersede ones who act as if they know, but they don't. But yeah, basically 628 golden ratio, hit TPs. What will you do in this instant? You will modify them again. Literally take them off, understanding where you're at, and modify them. Look at that. 20.6. Is that valid? That's not valid. Modify. Is that valid? That's not valid. Did it hit your TP? It did. But did it also create some support? It did. So you would therefore do it like that. And then again, remember what I told you. Once we are able to actually validate certain areas like this one, as even though, like how I told you, it was a 20.6, and then when you modified the fib, how it's intertwined at the 30.2, the market structure comes up here. Once this is broken, you don't have to wait for this area to be hit and like seen as broken. Again, I'm telling you, you will have wasted so much time in not applying yourself properly, understanding that the market could potentially come back up here and still go down twice. 1, 2. You can still make money off it going up to that area or region because of the high, that the time frame that you're on is very high. So understanding that, when you understand and see that, okay, this is still 20.6, but at the same time, when I modify my fibs to 30.2 mark was here, it broke past that previous structure point because it's still structure there. Don't invalidate it as structure, just invalidate it as a lower high, a valid lower high. So when it breaks it, right, obviously retests it. And look, lo and behold, we get that. Watch this. So by the time we understand that, we're already like this. So we could take this one off. Keep this in mind. Even draw like a random line if you need to in order to remember. Take this off. As you can see. 38.2. Did it hit it? Valid higher low point. Along with confluences. Like how I told you, these areas are always going to come into contact. So now what we do we try and trade right here? No, we don't. We break it down, understanding market structure had been broken several times before we even were made aware of it and understanding it, right? Breaking it down to probably like, see, 30. You normally will go time frame by time frame, but I'm just giving you certain practical examples. So watch this. Area is broken there. You ultimately didn't really get an opportunity to find any trade until over here. Like that right there, I wouldn't have felt confident in that area. It's too like how I told you, when it pulled back, you want to actually see some movement, some counter trend, some actual like momentum, So once we get down here, we obviously can see this 8 region golden ratio be tested and respected. Not only that, we're actually able to see market was able to wick out at this area as well as create body candles over here in this area. So when we're understanding that, we're also able to see certain areas where exhaustion have been previously and actually use that as actual confluence as well. And if I can see the estimates, they're a bit squirmish. This is a cool thing I want you to understand. You see on this time frame how the SMA and the EMA are? If you was to go up to an hour, right? Let's see, hopefully. And we're almost done with this video, guys. I just want you to be able to see certain things. So watch this. So you see how, watch this. You see this area right here where you kind of could go into it and understand. Let me take this off. Okay, first of all, the SMA and EMA. You see how it's kind of just in the middle, fucking around under actual market structure, and it's very just like indecisive in a way. That's a good indicator to understand this fucking area is in consolidation. And on top of that, I would need to either go to a higher time frame or a lower time frame to understand information. Understanding that this higher point hadn't been actually broken, it's been tested, and overall your lows is down here, right? So you will understand that and go higher. And lo and behold, what does the higher intel show you? Blues over red. Who's more in control of this trend? Is it sellers or buyers? Because usually buyers are more dominant when the blue is over the red, and sellers are more dominant in the market when red is over the blue. So who's more dominant in this actual representation? It's buyers. So again, you wouldn't therefore be so misguided or just like scared and not knowing where you are, because you will always be able to understand and know where you are when you're able to understand market structure. So when I break this down back down real quick, let me show you just how this area on the 1 hour was seen as like quite nasty, right? Like, let me take all the SMAs so you can actually see how I'm able to finesse this area in a bit. When you're seeing this wicks to the upside, wicks to the downside in some sort of fashion, hopefully you can see that, find the median. Find the median, because when you're able to find the median, understanding that this 618 was actually held off the 1 hour time frame, overall, us having our higher time frame fib in place, understanding that this 38.2 was also held. You see how it's all over just a sequence, that spiral effect. We would in fact be able to go down to like probably, and we can actually take this fib off because we don't really need it. We would go down to probably like 15. Let's see. Because I don't want to go down too low to where it can't show us. Okay, so watch this. So overall, another cool thing I use these random lines for, rather than just finding a support and resistance, is I'm able to actually I'm capsulating or kind of, I would say like following trend in a way that like when I'm putting it up here, I want to see a certain break, right? We didn't get it. So once market structure is found in a lower time frame, I'm mending it down to kind of like follow along with trend. Was able to break it? We got that, not even initial break or doji break or that. We just got that break, and then look, opposite color candle. So that's not a break. All the way up until we got down here, and I'm dragging this actual randomized line down to find a pinpoint where market structure is actually breaking this to continue the trend that it's on, right? So we eventually get that once we see this happen, and then boom, it kind of goes up higher, right? So ultimately, in a way, we're sort of looking for some sort of type of pullback as well as bullish variation to catch along with this trend. because we're already sort of understanding the trend we're in. We're just more so trying to manipulate, dominate, and understand where we are on lower time frames to take advantage of what we do and what we know. And an easy ass entry, I can tell you from just eye point looking is right there. Just looking at it. It's literally on you in your face for the momentum that's there. Take in mind, this is already you understanding what's happening on the higher time frame. Easy entry. Easy. You can go down lower. Hopefully they'll let me so I can show you guys this something. They won't. Like, it just, I went too far back. This is history. This is literally past history. This is April, right? So again, everything I'm showing you guys still applies. You will literally understanding what you know, enter right there, right? While minimizing your losses, your 1.1 stop loss and your 1.2 will literally be kind of down here. Again, 20 pips, just like the other example. And what are you trying to gain? Now right there, look at that. That's a 1 to 2. You feel me? And to be honest with you, you could have held it until market structure had broke up here, where you see that like kind of looking double top right here. Right. Then look, we didn't get the actual initial break until like this right here. So you could have damn near held all the way to like up here. Although you could have took it all the way up here, understanding your second TP is right here. So if you didn't want to hold it that long while actually managing this trade, like, dang, I don't know when to get out. You know when to get out because I showed you that once market structure is broken and you're understanding where actual higher lows and lower highs are, you don't want to be in on a trend once market structure is broken, because look what happens. Retest it. Look, retest it. And look, boom. Came right back down to where our entry standpoint was. And then look at that. Entry. So again, these are all over the place. It's not just in one area. This is like a continuum. It's just, it keeps on going. It keeps on going. It keeps on going. Like, I'll show you one more. That's like that. Where we actually presently are. You can see how that's forming right here. Today's Friday, so I wouldn't necessarily take a trade, but on Sunday, I'll actually have advanced unforeseen indications and intuition and just understanding where we are right now to kind of predict where I have a high possibility knowing where we could possibly even just go. How many pips is that? It's like 57 pips. That's good. But like, okay, area like this, like, we're actually able to see these sort of breaks happen, right? Just all these breaks happen. Breaks, like literally pinpoint them. Breaks. Breaks is structured. Breaks. Right here, look at this. Came up, came down. Right here. That's 100%. So this is an example of me showing you how the market was able to come all the way up here, make actual structure, resistance, green and red, to then pull back all the way down here, making support, red and green. And at the same time, look at where it's at 100% mark. Understanding this creates that understanding that market structure was not necessarily broken, where a lot of people will have seen this candle and probably thought, oh, we're going to continue going down. They're not understanding that market structure had not been broken at all. And it still indeed was going to head towards this actual overall TP for an actual range of 127 pips, it went up. So you understanding where it found support, right? You literally just dial down lower time frames, understand market structure, and literally take advantage of what you understand and know. It's an actual, like some sort of lower high there. Break it down to like the 15. Overall, did it like right there. All of these are 23.6s, just 23.6s. You know, but again, you have to be able to see these things. You have to be able to see that that's 100%. You have to be able to see that on the lower time frame. Lower highs are being broken and creating higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. And I can continuously keep doing this. Higher highs, higher lows. Like, look at that. It continues. But overall, in a higher time frame, it's creating these bigger candles. Like that engulfing you seeing. Like there's these engulfings on lower time frame. There are lower time frame structure being built up to create these big ass candles that you're seeing. And you have to be able to understand that and see that, right? So overall, guys, that is just many ways of how you are able to utilize the Fibonacci tool. And I hope throughout my examples, throughout just some of the trades I would have taken, that you are able to truly see that, dang, there's actual multiple ways you are able to utilize Fibonacci and are able to actually take advantage of it once you know what you're doing. So overall, that's the end of this video. And I hope you guys got good nuggets out of it. And I truly hope that I was able to help you understand Fibonacci a bit better. And as for that, I'll just leave it at that. And I'll let you just dwell on that information, and hopefully it just, you know, marinates in your mind and you're able to remember it forever and ever. And I'll just catch you guys on the next video. Peace.